Apologies for the Mr. Orange Man joke. In today's video, I'll be talking about the stocks that I'll be looking to add if Mr. Tariff Man continually tanks the market, as well as some of my portfolio holdings and how I'll be rating them so far. So for reference, this is my portfolio here. I update this weekly on the channel. So your Nasdaq forward PE ratio right now is at around 27 times. Historically, this isn't very high. So for example, in 2021, we went all the way up to around 34 times of earnings, 34 times of forward earnings. And currently now we're at around 27 times. I would like for this to drop to a 25 to a 22 times before it starts looking a lot more interesting again. The markets are still relatively highly priced, so I have to look to see if there are opportunities around. As for some opportunities that I see in the markets today, the first one I'll be highlighting is MasterCard. So MasterCard year to date is up around 6%. It is trailing your S&P 500 as well as your Nasdaq. So the stock now is currently trading at a 37 times of earnings. So for MasterCard, the thesis for the company is simple. The consumer in the US will not get weaker anytime soon because the US government is pushing out stimulus checks. So for example, over here, we have this $1,600 stimulus check that is being given out to all these US citizens. And besides that, we have the big beautiful bill, which is about to spur consumerism in the US. And that will lead to even greater consumer numbers in the US, which is overall bullish for a company like MasterCard. So for MasterCard, the fair value for the company is around today's price, I would say. The stock price now is at around $550. So assuming a 15% EPS growth and a 30 times terminal multiple for this company, you will get around a 10.6% CAGR, which is around fair value. Normally the fair value is at around 10%, which means that MasterCard today is probably slightly undervalued, but not too far away from its fair value. So for MasterCard, I think it's a quality compounding machine that you can add at any given price. The company is high quality and will stay around for many years. So for this company, I think it's a decent company if you're looking to add in a quality compounding machine. The next company that I'll be looking at is Amazon. So Amazon year to date is down around 2%, currently trading at a 33 times of earnings. So for Amazon, the valuation today looks pretty sound. So the price to operating cash flow is at around 20 times. And historically, this is on the lower side. And besides that, you have many different catalysts coming up as well. So you have your Prime membership hike next year. So it is projected, it is based on cycles, that they'll be hiking up their Prime membership next year by $20. This will bring in a $3 billion additional revenue for the company. And besides that, Amazon has optionality with Anthropic as well. So what we've seen with Microsoft and OpenAI could happen with Amazon and Anthropic. And if that happens, then Amazon's AWS portion will grow a lot faster than what it currently is today, which is a catalyst for the company, and the company will probably re-rate to a higher valuation multiple. So for Amazon today, just assuming these numbers here. So for Amazon today, here are some napkin numbers that I put together on my X account. So this is using a P ratio multiple. Of course, you can use your price to operating cash flow for Amazon, but it is unlikely that they'll be removing their R&D spend. So the price to operating cash flow artificially deflates their earnings multiple. So assuming all these assumptions play out, then the company at a 28 times terminal multiple will give you around a 12% CAGR, which is reasonable for a company like Amazon, and it clearly signals undervaluation as well. So for Amazon today, it is a buy. It probably is a buy. The company is the only Max 7 company that is trailing the markets. And I think Amazon is like Google when it was at around $200 a share. Not extremely undervalued, but around fair value and reasonable to add. The next company that I'll be highlighting is this company called Intercontinental Exchange. It's ICE. So the stock is up around 5% year to date, currently trading at a 30 times of earnings. So for this company, if you don't know what they do, they own your NYSE. They own many data businesses as well, selling data to your asset managers, to MSCI, to S&P Global, to Capital IQ, and so on. And this company has more than 90% of the business coming from recurring lines. So for this company, it is also one of the high quality Colgate companies out there in your financial markets. And for this company, the valuation today is pretty sound as well. So the price to free cash flow is at around 20 times. And if you're to compare this to all the other financial companies, like for example, S&P Global, MSCI, Moody's, Nasdaq as well, this company is currently trading at one of the lower ends in terms of its multiple as compared to all these other companies here. So for this company, I think it's reasonably priced. I'll be digging more into the company and hopefully I'll get an update soon. The next portion, I'll be covering some of my holdings as well as the ratings for all these different businesses. So I'll be rating some of the companies in my portfolio today, and I'll be rating them based on strong buy, hold, or trim soup. So the first company on this list here is Google. I think Google is a company that is fully priced today. It is not extremely expensive. It is not extremely cheap. It is probably around fair value or slightly overvalued as well. So for me, this company is probably a hold in the long term. I think the company has constant innovation risk. There's a lot of risk associated with a company that needs to continually innovate to stay ahead of the game, unlike Microsoft. So for Google, I think it's a company that I would hold for the long term. And so far, it's been doing very well for me. The next company that I think is a buy today is Amazon. So Amazon, I think it's a buy. It's a decent company that is trading slightly under its fair value. So for Amazon, I think there's a lot of optionality in terms of the business lines. They have a lot of levers to pull. They have many different business lines that can go parabolic in terms of earnings if the company wants to pursue it. So for Amazon, it's a decent company and I will rate it a buy today. Next company is Microsoft. Microsoft, it's a hold, it's a juggernaut. It's an expensive juggernaut trading at a 37 times of earnings. I will probably add Microsoft only when it drops to around a 30 times of earnings. The company is great, it's irreplaceable in your corporate world. Everyone uses Excel, PowerPoint, and so on. So for Microsoft today, it is probably one of the unbreakable juggernauts out there. And for me, it's a long-term hold for this company. Next one is S&P Global. This company is a decent one in my portfolio, one of the multiest companies out there. And for S&P Global, I think it's a buy today. The stock price has been falling since the all-time high price just a few months back. So for S&P Global, you have tailwinds coming up for the company as well. You have your interest rates falling, you have your debt wall maturity coming up. So there's a lot of option with this company. And assuming that indices portion continually grows with secular tailwinds, this company is a long-term compounding machine that will probably give you decent returns over time. Next company is MSCI. MSCI is probably closer to a hold for me than a buy. It's probably somewhere in the middle there. MSCI is not particularly cheap. It's a decent company, a high quality one, but it's not as high quality as compared to S&P Global, which is why I would rate it slightly lower than S&P Global today. But nonetheless, it is still a high quality compounding machine that is in my portfolio today with recurring segments and predictable business lines. Next company is United Health. So for United Health, I think it is slightly closer to the trim than to the hold for me. I think this company has done pretty well over the past few months. It's up around 50% since the lows. And for United Health, for me, it's not a long-term company that I would like to hold in my portfolio. The company was a company that provided asymmetrical upside, and I just added on the way down all the way until around $250 a share. So I think for United Health, the company is undergoing some form of a change. It will probably re-rate, it will probably return to its fair value sometime soon. But for this company, there are many different risks associated with it. And the insurance business line is one of the weakest business models out there as well. So for United Health, it is hold, maybe a sell soon if the company goes parabolic and if the fundamentals don't follow. The next stock that I'll be covering is FICO. FICO is a decent buy today. I think the company is closer to a strong buy. I would like for this company to drop to around $1,500 a share before I start adding into it again. There's a company that is about to grow 70% in terms of net income next year if they're able to double their FICO score prices. So for FICO, it's a decent company. It's a high quality company that will go parabolic in terms of its earnings next year. And this is assuming your mortgage activity doesn't recover. So for FICO, I'm hoping for this company to drop a lot more so that I can add to my position. So for now, it's between the buy and a strong buy. Next company is ASML. ASML is around a hold to a trim for me. The company is a business. The company is a high quality business, but of course your semiconductor industry is cyclical as a whole. I mean, if you think that hardware can continually going on and on and on this bull run for many, many years to come, then I think this is false. I think it is disillusion for you to think so. So for ASML, I think it's a company that is cyclical. It is going up on this uptrend right now, but we could see the downtrend soon as well. And the company is probably around fair to slightly overvalued. So for me, I think if ASML continually goes up in terms of its stock price, I may look to trim this position soon. The next company that I covered previously as well is MasterCard. MasterCard is a buy for me. Same thing for Visa. These two companies are high quality companies that are being suppressed in terms of stock price because of your narratives around crypto. And for crypto, it will probably take another 10 years for consumers to get accustomed to it. for crypto to gain market share from all these payment rails. And for these payment rails as well, they are actively pursuing their own crypto models. So they could certainly benefit from this. And for me, I think these two companies are high quality compounding machines I would like to hold for a very long time. The next company is Copart. Copart is probably close to a buy for me. The company is trading at a 27 times of earnings, and historically the company buys back a lot of shares at around a 25 times of earnings. Of course, this is all speculative in nature, but the company has a very strong business line, and your used car portion, your salvage car market, is projected to grow at a decent high single-digit rate over the next few years, at least. So for Copart being the market leader in this segment, it will likely grow faster than that rate. So for Copart, I think it has a durable business line that will continually compound at around 10 to 12% over the next few years. And at a 27 times earnings today, for a highly predictable business like Copart, I think it's a reasonable price to pay. My next entry will be at around $40 a share. Hopefully it drops to that price so I can enter into this wonderful company. The last stock is Warren Metco. This company is a buy. The coal market is decent today. The coal market is recovering today. And we could see parabolic moves in your coal market once it reverts back to the mean. So that's all for this portfolio segment. I hope you guys have found this one useful and invest safe.